It eventually got up to 107. But the range shift alone, you could have been pretty confident and strong in your belief that something was taking place in late May, which you got confirmation of in early July. And to move from 100 to 107, if you're buying anywhere around that 100 level on that pullback, the top bottom level that we broke in May, if you look at the RSI in May, again, you get a 3-period signal with this rising bottom where we had the little 3-period bullish in May. The market shot up and sold off again. If you look at where the price action was during that time, we got up near 100 and came back down to 98. So the first high that we made off the low, the extreme low that was made, the first high and down to retest that low in late May, draw a line across here, across that high, intervening high, and say that was a top that was made before the second divergence was formed. So if it breaks it on the upside, it was resistance, should become support, and there's a hash mark. I call it a hash mark, but a closed mark resistance or support line that you can draw across just above 100. It goes up and comes back and tests it again in early July when the RSI come back to 40. I could spend all day on one chart because after a while they do talk to you. But the range shift rules, as soon as you think you've got a change in range, you have to change your mentality, your temperament, and be focused on the new trend which should be emerging. Depending how aggressive you want to be, you could have bought that on the pullback into about mid-June because you were breaking what was that near-term resistance level when price first started up, had a peak, come down, created a bullish divergence. Draw a line where that price resistance was because then it broke it and came back to it before it went higher. But that's only because you know about positives and negatives and range rules and everything else. The average trader looks at that and says, well, that's a double bottom. And when it rallies from late May, most of them will see the RSI go up through 60 and say the RSI is moving up the chart. Most brokers will call and say the market's on a strong move. It's moved from 98.5 to 101, 102. The public comes in where? Mid to late June. They say, that looks like a breakout. We're going to move more money that way. It's actually just the first leg up because you had the range rule shift, but you haven't had a complete turn. Your next chart I put in was IBM. And just a quick note on that one. Look at where we're at in May. Yeah, price is kind of sideways to higher in May, April, May, and into June. But look at where your RSI was in April and May. In May, it was declining. The RSI was declining. The RSI had a hard time around the 60 level in early June. Because even though price was trying to work higher, price was actually trying to get into a wedge type pattern. But look at the declining tops in the RSI in late April, early May, late May, early June. You're getting multiple bear divergences. Bearish divergence is usually bullish. But when you're seeing bearish divergence and price not taking that divergence out, you actually had a couple little positive patterns mid-May late May, RSI was showing a longer term positive versus price, right? If you see it and you see the RSI is also failing to get back above 60, it should give you some indication that you're undergoing a range shift and you're going to reverse and go lower. But we did reverse and go lower into late June, early July. Price action again went sideways. Market leaders like IBM, Microsoft, used to be like GM too. People don't want to give up the ghost. They believe in those companies. They want to keep buying them on every dip. They want to keep buying them on every dip and turn around and expect to see it go higher. But in this case, it wasn't. Went into like a wedge at the top, and then it went sideways in June or in July and August. The price action was a lot lower in July and August versus where it was in May and June. The range had shifted. Those positive patterns, which we thought we were seeing in mid-May, where the RSI came down near the 50 level, then went back above the 60 level in May, and then in late May dipped again. You look at your price action, you should say, well, it should be a positive, it should move higher. The positive reversal that should be developing is not developing. It's failing to develop. The best sell signal is a failed positive. If a positive reversal target cannot be hit, then it could be in trouble. Not only that, if it does fail, it should be your first line of major resistance, your previous positive reversal target on the way up. If it can't get there, it sells off, that becomes a resistance point. And in late June, we had multiple attempts. You took the basic bar chart at the top and took the highs in May, through the lower highs in June, through the lower highs in late June. You're drawing a downtrend line, declining top. You have a declining top in price action at the same time that you're starting to see bearish divergence with positive reversals. And we have a complex pattern we're going to show because this pattern shows up a lot. The RSI is failing. The price is failing. So momentum and price both are failing to continue the upside move, which had been underway. And in late May, we broke below 50. Early June, we could not get back above 60. If you took the peak on the RSI in May, extended through the highs that were retesting May, in late May, where you had another little divergence, most of the RSI action between the 1st of May and the end of June was all below that trend line, that RSI down line. Also, in your price action, you broke what had been the bottoms around 112, and the lows that were made in price in May and June were actually a little bit below the highs that were made in July and August. So this is telling you that the market's in trouble. This particular market, IBM, was in trouble actually last June, July, into August. And you look in August and you're seeing evidence of the 1st of August in the RSI versus the latter part of August. Go up to your price charts above it, you're making lower highs. You're making longer term negatives. The range has shifted. This is how I was able in a July commentary to say the market's in trouble and we could be a hell of a lot lower by the end of the year. People told me I was crazy, but I was seeing this in a lot of stocks. Also saw it in the Dow Jones itself. Same type of pattern and range shift. But range rules, when they're shifting, it's not subtle. It's something that pretty much jumps off the chart. Plus the fact that you have positive reversal targets that are not being achieved on the upside. Your next chart is Boeing. And this is one of my favorites too. And it doesn't matter if it's stocks or bonds or anything. But you look at how the market had bottomed in September And look at how the RSI had gone well below 30 during the month of September with everything that happened, but it slowly, gradually climbed out of it. And in late October, it was back around the 50 level, stayed a little bit below it in November, and then pushed through it in early December, corrected back to the 50 level in mid-January. Now, there's your range shift. Price action is going in the direction that the RSI is going. Your next one is just for you to remember. We're looking at an RSI. I talked in the basic courses about naked signals or enhanced signals. When you're using moving averages, you can get further confirmation of price movement by combining both the moving averages and on RSI and on price. And there we have guidelines number 5, guidelines for moving average interpretation. If both the RSI moving averages are up, the 9 is above its 45, and the closed moving averages are up, your trend is up. The RSI is more sensitive, so when its 9 crosses down below its 45, your closed moving averages still stay higher. So it's side up, then we have side down and down. I've lectured in public and taught classes since 1986, and I've never changed these guidelines. The strongest signals you're going to see are when both moving sets of moving averages are up or both moving averages are down. The chart we had before with the bonds, that's why when it was at 98.5, I say it's not as strong a signal as it was when it showed that the range had shifted, because by that time, both moving average on RSI and price had the time to turn, basically turn and confirm the shift that you were seeing in moving averages, or that you were seeing in the range. This chart in here, actually, if you look in the lower right, July of 93. This was a chart that was part of a presentation I gave to a CompuTrack conference. The rules have not changed. The guidelines have not changed. I even, at that time, put this in and said, this is a basic little program. And now that you've gone through basic RSI and you've learned about this, the simple 9, if the close is greater than the simple 9 moving average and the RSI value is greater than its simple 9 period moving average, they're both moving in the same direction. When you get home or you get a chance and get some time, just look at a bar chart with a simple 9 and an RSI 14 period with a simple 9. And look for what you see when both the closing price is above its moving average and the RSI is above its moving average. Your next chart, next page, positive and negative trends. This is what I call the acceleration factor. Short term on the top chart, top left, says positive trend, 1, 2, and 3. If you're looking at the 45 period moving average, or even a 20 period, 20 period is more shorter to intermediate term. The 45 period moving average would be more longer term. If the moving average of RSI is below 40 and then starts to rise and crosses 50, it's trying to turn up. The short-term trend with the moving average being that far below 40, short-term price action is usually down. When you see it go to 0.2, from 0.1 to 0.2, it means price action has probably started to turn up a little bit too. But with the RSI moving average, you're spreading it over time, and the fact that it was in this market evidently was in a strong downtrend and is starting to come base back up on this positive trend chart. When that 45 comes above 40 at 0.1, you're probably working on a short-term low. When it rises, the 45 rises above the 50 level, you probably have a short-term low in place and may change the trend to side down or at least side. And then it'll go sideways for a while. And when that 45 on RSI, now, and what I'm using is an exponential 45, so I can incorporate every piece of data I have on that file. When that 45 goes above 60, like it did here on the top chart at 0.3, you don't want to be short. Okay? Because you're starting to get, it's actually like the 58 to 60 level. The RSI is probably well above 60. So your range rule has already shifted in the RSI. Now the moving average acceleration, because I mention this quite often in my updates, that we're about to enter an acceleration phase. And when I had said to people back in August, based on what I saw on IBM and everything, that the market looked like it was going under 8,500. And then I come out and we'll see it because we have the chart in here, that we're starting the downside acceleration in September or in mid to late August. If it broke the 40 level, I was referencing the 45 period moving average on RSI. If it broke that, the market probably would have gone all the way down to 7,400. But we had an outside force on it with what happened in New York. But the guidelines here of 1, 2, and 3, when the trend starts to turn up on an intermediate to long or short term basis, 0.1, intermediate type turning up, 0.2, and when you start to see this RSI 45 get up near the 60 level and ready to break it, you're going to get some big movement in that way. You might get multiple divergences in the RSI, but those divergences should sell off into positives. Because by breaking 60, if a market's in a downtrend and the range rules say 60-20, 60 is resistance. Now you have a 45 period moving average of the RSI breaking up out above the top end of the bear range for trend. If you look at it that way. The second chart is just the opposite. The market had been at the upper half of the chart, and the 45 period moving average started to roll over and turn down from above 60. Then it went sideways for a while, and then the 45 broke below the 40 level at 0.3 on that bottom chart. The yen broke below. The yen March future was around 83. Sold all the way down to 78 or 77. Just looking at the acceleration rule, just looking at the acceleration, as soon as it crossed the 40 level, it was breaking 78. I thought it had the potential to go all the way to 72. But it's a good indication if you're trading, well, there's futures traders or stock traders, but if you're trading stocks and you see that 45 go below the 45 on our side, go below the 40 level, that's not a stock you want to be into. Because it's going to be down for a long time. And it could be a hard down. If you're breaking out the 45 on our size going above the 60 level, that's something you want to be in for a long term on the way up. But these acceleration, the reason I like using the acceleration is it helps me to further identify those stock issues or futures contracts or cash market or whatever, that there should be an explosive move one way or the other. The charts that I put in here for you to look at, I also included the next chart should be a bond chart. December bond 01. If you look in July, at the bottom chart, the RSI had crossed above the 45 period RSI crossed above the 50 level. You look at where it was in September, the RSI had come back to 40, and you had a longer term positive in it, but you also found support at that 65 of high, or excuse me, 65 of low. At the same time, you're at the 40 level. Then you went up to a new high in November and made the bearish divergence. When we had talked about the chart earlier with the bonds breaking above the 50 level and then coming back to find support at the 40 level. Another indication that the trend was changing. Here you've got the longer term 65 high-low. And we'd gone through this before in terms of using moving averages on high and low. And the reason I use 65, I went back and changed and checked a few things over the years, and 65 is still, to me, a good long term because there's some time cycles. We had talked about the 4-week, the 9-week, the 13-week. If you break the full year in half, it's 2 26-week cycles. Into quarters, it's 4 13-week cycles. 13 weeks times 5 days a week is 65 days. This is a great long-term set of moving averages to use on price. Using them in conjunction with the RSI moving averages. Your next one, next page, Walmart. Even though the 45 on RSI did not break above 60, you had multiple RSI longer-term positives. Price action stayed above the 65 of low all along the way. You look at the RSI chart, you had bearish divergences all the way in October and November, and then another one December longer term, and then late December, early January, another bearish divergence as you made new highs, but the RSI didn't. But all the time, the 45 on RSI stayed above 50, pretty much above 55, even though it didn't accelerate all the way up. Your next chart after that is a Walmart that has the 65 and the 13-week high lows on it for you. The next one is a T-bond chart with the high low 1365 and the RSIs. And then you look at January, February, and March on the RSI chart at the bottom. Think it was having trouble at the 60 level? Not only was it having trouble at the 60 level, that last rally where it got up almost to 105, you had positive reversals that were being achieved on a price basis intraday, but never closed above it. So that tells you we're running into resistance at the range of 60-20. The range has probably shifted. You had 3 good attempts at it. Even your high-low moving averages, as you look at the interaction between the 13 and 65, the 65 was kind of rolling over. The 13 high-low bands were coming up. It was outside the band a couple times, but we couldn't break 60. We didn't even see the RSI 45 pairing average really didn't get much above 50 before it turned down. Started to roll over. Your next chart's got one with Euro. September Euro when it made a bottom in June. Then it retested the bottom in July. Then if you look in early August where the RSI had pulled back, it had been above 60, pulled back just below 60 before it ran to 80, and then sold off in September. That was just a momentum high that was made in August and a quick price high, and then it sold off again. But the RSI moving averages, look at the 9. You can even use the 9 in this acceleration mode. But I really prefer to use either a 20 period or a 45 period. But look at the 9 from the low it made in July. The 9 period moving average on RSI at the bottom crossed the 45 in June, sold off back to near the 45 in early July, and then took off and crossed the 60 level in late July, early August. And it was moving. You look at the slope of that line, the way it turned up. Look at the price action on the high lows. So moving averages are not just for closing price. Use them on RSI, use them on price, and you don't have to stay with just one set. This interplay between the 13 and the 65s is very, very helpful for identifying bigger moves. When that 13 set of 13s cross above the 65s to the upside, you're going to get a big move up, especially if you got the range shift in place. Your next chart with the crude oil. In early November, we had a little bullish divergence form. The market rallied into late November, early December, sold off into mid-December, but the RSI didn't break below the 40 level. Then you went up and you made a bearish divergence, actually late December, early January, near the 60 level in the RSI, which is interesting because the charts that I've selected to put in here show all the different things that we've seen beyond what was learned in basic. I always try and find not charts that look good, but a chart that'll tell a story and the different patterns that show. Now, you've got a bullish divergence on that chart in late November or early to mid-November, a rally where the RSI rallies to near 50 in early December. The moving averages on RSI turned to the upside. The 9 crossed the 45. So that tells you it's at least side down. It's no longer down. They always talk about the first one there gets the big prize. Well, the quicker you can see a trend change developing, the quicker you can be in position to take advantage of it. And it rallied into late December, early January, made a bearish divergence, which comes in a downtrend, which is the belief of most people. But if I see a bearish divergence and price is rising, I say the range is shifted. Bearish divergences come in uptrends, unless it's the final divergence. And then it sells off in January. It says, well, you didn't get to buy me in November. You didn't buy me in early December. I'm giving you another chance to buy me at the 40 level. You see the first attempt there where that bearish divergence was formed in January. Prices were breaking out above the 65 of high. The 13 of high almost got above the 65 of high. Then you had one more sell-off into January, late January. Found support at the 40 level. If you look at the low on your price bars in mid-December, look at the lowest low and the lowest close in mid-December, and then draw one of those clothesline supports with that clothesline, or with that hash mark, as I call it. Shouldn't say hash mark in the world of drugs. But in December, you had a little close where the RSI was testing the 40 level, and where that close is, if you extend it across the chart, you'll see a retest off in the January low. I put some other charts in here. One I go to is about 3 or 4 forward. The Microsoft chart. You'll see that Microsoft at the top, it's got a set of bands, middle chart RSI, and the bottom chart a set of bands with Microsoft, where it says high line, low line. That top chart is a bar chart. The moving average in the middle of that band is a 90-day simple moving average. So mark that on there. It's a simple 90-day on close. The upper band is 6% above the moving average. So you figure out what the moving average is, and your high line becomes the moving average value times 1.06 to put it 6% above it. The lower line is 6% below it. And I've got some of the programming written for you in a format to where you can read and see what their values are. But when you're using the 90-day, use a 6% band. The bottom chart, where it says moving average 2, high line 2, low line 2, is a 21-day simple moving average with the band set 4% above and 4% below. Gives you a little perspective that you don't have with just high-low bands set on the actual price of high-low. Here you're incorporating the moving average over 90 days, which is longer term, and 21 days, which is shorter term. Your next chart, euro, same thing. High line at the top, 90. Simple 90 with 6% bands, low line. 21 period moving average, 4% bands. Gold is your next chart. Same parameters. Top is 90 with 6. Middle, 21 with 4. And this is why I've gotten excited about gold. If you look in December, when it was making the lows, it's made a low in December in price. Just look at your top chart. A low mid-December, then a higher low. Then in late January, we made a higher low. And in early February, we broke out the top, which tells me two things. The intermediate to longer term trend is changing. Some people like to put Bollinger Bands as a good band. Keltner bands I've looked at. I've looked at the Stoller bands, Manny Stoller's average true range channel bands. Sake of simplicity, percentage bands stay constant with that percentage. Where the Bollinger Bands tighten and compress when volatility decreases and expand when volatility increases. I've just seen better action personally out of a simple band, even though I covered the intermediate course, I covered Bollinger Bands. The advanced course, I covered the Stark Bands. They have merit. Again, it's a personality thing. I present this in this format, in edge format, because having the courses, you can go back and check Bollinger Bands, Stark Bands, Keltner Bands. I never covered because I always liked the Stark Bands and the simple bands. But the longer term perspective that you get with a moving average high-low line versus the Bollinger Bands gives you a perspective on not a smaller scale, but less volatility in the bands where you can actually really see what price action is. Not only that, with what we were talking about, drawing a line on the closing price, where that close is on a bar chart, extending it across the line or across the chart. When you see where you're drawing the lines on these percentage bands and the actual moving average, which is on your next page, where I took the simple moving average 90 with the 6% band, I added a 45 on close. The 21-day band with the percent set at 4% above 21-day value, I put a 9 period. That helps. And it helps not only to see resistance and support and trend, but it's a clean picture, a straightforward picture, and I marked a couple of charts that way. But the Bollinger Bands are good. I covered those in the intermediate level, and then I covered the Starks in the advanced level of the course. They're defined on volatility. They're going to expand and contract based on volatility. The Bollinger Bands are set 2 standard deviations above the moving average. Some people use 1.5, some people use 175, depending on the personality of the person using the band and how much risk and volatility you want to see. Same thing with the RSI. You can put the Bollinger Bands on the RSI. We've done it in the course. But the simplicity that a moving average on close, number one, gives you as far as trend and overall perspective. Being able to see, like we did on that gold chart, it broke out 6% above the 90-day moving average on that gold chart. To move 5 or 6% above a moving average, or even break out 4% above a 21-day. Says there's got to be something behind it. The ensuing sell-off did not take out the previous lows, and the bands were gradually rising, which gives you that longer-term perspective. I am not one that wants to sit in front of a computer all day long. I like to look at the close. I like to check the hourlies and sometimes drop to 15 minutes. But what you will see with the 90-day moving average in the percent bands is a cleaner, longer-term perspective. There's a couple examples in there with the moving averages. There's one on the Dow, a couple pages forward, where I put the 90-day with the 45-period moving average on close on the same chart as the band chart. Marked Dow Jones Index, September 01. We were talking before how the range had shifted in July. In the RSI, and it looked as if the RSI was not going to continue back up through the 60 level in the summer on the Dow. When you look at these percentage bands, the highs that were made in June. Now, the bandwidth and everything is going to be dependent on how much data you have in that data field. But even so, it was above it in May, and then it retested it in early June. In July, it broke below the 90-day moving average, and I had put the 45-period moving average in on close to be able to help out and see what the longer-term perspective was. But these bands are very, very helpful for seeing where these things should turn from and what are going to be good long-term support and resistance. The rest of this section is what I had called in our original course MAC track, if you remember the MAC track from intermediate. You take the spreads of the moving averages, plot them as a histogram, and then watch the second set of moving averages, which you're now doing on the histogram, to give you an indication of what the longer term direction is. Put one in on Home Depot is the first one. Cheesecake Factory, the second one. Boeing, and this, I was telling someone else, this to me is where the MAC track, even though I designed it back in the mid 80s, because I was trading futures, works better in stocks. Not better, but because stocks do not move as quickly as futures do, it tracks them very, very well. So you want to see the histogram give indication. You will see divergences in the histogram. You will see how the histogram, which is based on the first set of moving averages you use, when you put that second set on there, it double smooths it. But watch the histogram in relation to the moving average of the histogram. It gives you early indication that something could be turning. But these I put in just as examples. I also put a CRB index in there because I do think where we are now, we've made a major bottom in commodity prices. I think we've seen a major low in the CRB index. After the cheesecake chart, there's a Boeing chart, and after the Boeing chart is the CRB index. Longer term, it's got both histograms on there. But I think we've seen a major bottom. I think instead of looking at the Dow Jones, you might want to start looking at the CRB. Gold and silver appear at the bottom. Grains are trying to bottom. And the CRB broke above the first target I had for it of 202 on a weekly close, which was one of the reasons I had scheduled this weekend conference for mid-March, mid to late March, because I expected in the first quarter of the year, many markets that make important lows January, February, March continue in that direction the rest of the year. When that CRB back in September was under 182, we were setting negative reversal targets of 187, 92, 96, 98, weekly targets above 202. We've closed above 202. After that longer term perspective on the CRB chart, I also put a second one in with closer up view so you can see the relationship of the histogram to the moving average. Now, as far as setting a set of moving average guidelines, you know how much I enjoy the 9 and 45 on close and RSI and do the MAC track with 9 and 45. If you want to shorten up your time frame, use 4 and 20 on the moving averages of RSI and close. And then when you get the histogram for the MAC track, which is just the difference of those two, then put a set of 4 and 20s on there. But as far as the things I enjoy and feel best to use with moving averages, it's still, after 15, 20 years, the standard on this 9 and 45. 9 simple, exponential 45 for both price and RSI. If you want to use a 45 period weighted moving average on both the RSI and price, it's fine. That's where I originally started. I'd suggest you keep both. You know, when you write it in your program, write simple 9 on close, exponential 45 on close, and under that, weighted 45. So you can toggle back and forth and load what you want, because the 45 is going to be a little bit more sensitive if it's weighted. It's designed that way. And it's only looking at 45 period blocks and weighting it more to the end. The exponential is incorporating everything in the database. But nothing has changed in 15 years about the guidelines. 9 above 45 up on RSI and close, trend up. 9 and 45 on RSI down and close, moving averages down, trend still down. But if you're in an uptrend and the RSI moving average dips down, you haven't gone from up to down. You've gone up to side, look for corrective pullbacks, do your homework. I include it in this section because using those guidelines that we went over years and years ago and bringing in the simple 90-day with 6%, simple 21 with 4%, we covered in the course. If you want to use Bollinger Bands, Keltner Bands, Stark Bands, that's great. But the longer term perspective to me is still the most important. And being focused on big moves. You get caught in a volatility band where you think it should contract or it should expand and it doesn't, and it starts messing with your head. I spent a lot of time this morning on your mindset. But I know John just finished another book, which I think would be a good read. And I'm going to probably call him and ask him to send me one. But when we talk about whether it's when you're in college and they say, or out in the sales business, and they say, keep it simple, stupid, you know, all this. This is as simple as you can get. This is your start. If you want to go from a 90-day moving average with 6% bands to a Bollinger Band, to a Stoller Band, to a Stark Band, or a Keltner Band, that's fine. But have a base and a longer-term perspective of what you're looking for, especially like that one with gold and the CRB. The gold broke out of the top, and it's come back and it's not dropped below the moving average. When we talked about drawing closing price, clothesline supports or clothesline resistance, where that close is on a bar, last Friday, gold was 290.10 where it closed. The low for this week was above 290.10. And we closed up $7. So we come up off that band and started up. Now this will complete the moving average section. The next section we're going to cover pattern recognition in more detail, divergence, and it may actually, in 3 and 4, bounce back and forth between positives and negatives and bull and bear divergences. But the patterns that we're going to cover, we saw one already, rising bottoms, signal counts, the flats, the complex patterns. Some of them you're probably going to want to take, copy, reduce, and tape it to the front of your computer. So it's a quick reference once you see it. So this completes section 2, and we'll start with section 3.